not there. I'll get Kelly to throw it
This
up
is
there
Penny.
today. Hello?
Morning, everyone. This is Penny.
Yeah, go ahead.
Just want to remind everybody, because Kelsey and I have been looking at everybody's progress, that if you're not probably done Unit 2 by now, you're falling behind. And we would like to see everybody done Unit 2 by now. We want you all to write the exam in November. For those of you that want to write the QAFP in June, we want that to happen too. So if anyone has any questions, concerns, I will type my phone number and Kelsey's phone number in the chat line, and you give a call or send us an email.
Thanks. Okay, let me just crack it open here new and see what we get. Oh, that's okay. Yes. Okay, I'm just going to mute you there, Mom. All right. That's not the chapter. Yes, that is a problem. Okay, so let me just. She's still there. Yeah. Are you there right now still? You hear me?
Yes.
Yeah. Can you ask Kelly to upload? He's got the. Just ask him to have a look at what's uploaded for chapter 11. He's got the wrong thing uploaded in chapter 11.
Yep, I'll do that.
Thanks. Okay. Have a great
Good day, everybody.
Yeah, I think so, Ksenia. Sorry, are we looking at Moodle right now?
We are.
Yeah, so I'm gonna guess, Ksenia, that you're having something wrong with your display. Just check all your cables and connections, and exactly, and then log in, log out. Standard IT response. Okay, perfect. Now, Happy New Year, everybody. And are there any, that's a good question. I'm not sure when people picked up on that, but would have been super helpful to know that before. All right, so anyways, are there any, oh my goodness, no, Jalen. All right, so are there any other questions before we get into today's content?
Jalen, I'm sorry to hear you thought it was only 3 pages. We all know Jason better than that. He never lets you guys out 1 minute early. Never says this is going to be easy. And I don't think he can say anything in 3 pages, Jalen. So we're sorry to hear you were excited. But have a good day.
Okay, go ahead with your questions, Jalen, now that I've been picked on appropriately. All right. Yeah. You want to come off mute, or are you going to? Okay, Sharpe ratio. Yeah. So maybe what I'll do, just plug it in here. No, so this is a good question. I like this question quite a bit, actually. And what Jalen is referring to here is when we calculated the Sharpe ratio, this is something we would have talked about today anyways, so just as good a time as any now to bring it up. When we did Sharpe ratio, you may recall that the formula here was that we're going to take the portfolio return or the rate of return, whatever the return you actually get, minus the risk-free return divided by the standard deviation for the portfolio. Okay, which is properly, if I were doing this right. No, there we go. Okay, so something like that. And you may remember then, so rate of return is simple. Rate of return is just what did the portfolio get? That's nothing complicated at all. And the standard deviation, we talked about quite a bit. Standard deviation, remember, that's how much volatility there is in the portfolio's returns. Okay, and then your risk-free return. Yeah, so normally what you'll see, and there's actually a lot of sort of academic literature about this. You could find people who write grad papers and all this on what the risk-free return is. So yeah, we normally use the 90-day T-bill rate. And the reason we use the 90-day T-bill rate is because that is as close as you're going to get to a risk-free return, right? So you should be using, Louis, the return that the investor actually got. Now, this depends where you're looking at it, right? Because the fund might express its rate of return, and the fund's rate of return isn't necessarily net of all investor costs, right? If the investor has costs that come in after that, then yeah, so you could get a different rate of return for the investor versus the fund, right? So there's no one universal way to do this. It's a matter of perspective here. Whose perspective am I looking at? Now, that being said, I would suggest that because Sharpe ratio is all relative, unless you have a fund that has really extraordinary fees, but if you're comparing two funds that have fairly similar fees, this shouldn't throw things off very much. But yeah, you're right. If you're looking at one fund that has a 5 basis points MER versus another that has a 200 basis point MER, then yeah, you better be making that distinction. Okay, so the reason we use 90-day T-bill rate is it's very liquid, that there's a very low chance of default. Okay, whatever criticisms you might have of the government of Canada, I think everybody on the call would be equally shocked if the government of Canada went broke in the next 90 days. That be fair? We've had no indication of such a thing as being anywhere near likely to happen. Okay, so the reason we use this one is because for most investors, this is the closest you'll find to a riskless return. Now, you could stay in cash, then you have a 0% return, but cash is not riskless, right? Cash is subject to at least inflation risk. So whatever, there's risk everywhere, but the closest we can get here is your 90-day T-bill rate. Now, that being said, there's some theory here, and this kind of ties into your question too, Louis. There's some theory here that says that, in fact, I shouldn't be using the universal risk-free return, but rather I should be considering what's the risk-free return for this investor. Okay, and I will show you what I would use here if I'm actually calculating this for an investor. Any thoughts here? Anybody have an idea about what would be an appropriate risk-free return for the individual investor? So why 5, Jonathan? Where do you pull that from? Where is an investor going to go to get a 5% return that's risk-free? Okay, so that's one thing we could look at. We could say, what would you get on a high interest savings account? I could maybe use okay, that's fair, yeah. So I could maybe use a high interest savings account. I could use GIC, Ksenia. The challenge with GIC is it's not really risk-free, right? You give up liquidity with a GIC, but I've certainly seen that presented So there's nothing in the FP Canada tables that gives you a risk-free rate, Jalen, and that's where I would have a concern with that. That's very similar to, I think, Ksenia's suggestion of the GIC. Maybe if I have a redeemable GIC, that might be the risk-free return that I might use. What I like is if you're carrying any debt, then you use the rate of return on that debt or the interest rate on that debt. And I think a lot of times we would make better decisions if we considered that our risk-free return. So and I know this gets ugly, but that means if you're carrying, let's say 19.99% interest, or sorry, 19.9% debt on a credit card. So if you got somebody who's not paying off their credit card, they get a risk-free return by paying that off, don't they? What do you figure here? Is that a risk-free return? Well, I certainly think it is. Why not? Aren't you getting that return, Jalen? And it certainly points me in the right direction here. Okay. But your net worth changes by that much, doesn't it? Isn't that what we mean when we talk about return? The return is the impact on your net worth. Okay. And that's where I would suggest you take whatever rate of return you're getting on your credit. Now, that means if you're not carrying a credit card, if you got a mortgage at whatever, 2.49%, hey, maybe that's your riskless return, as long as you can make any payments to it. If you can't make early payments, then no. But I would suggest if you have a mortgage at 2.49%, that's your riskless return. Okay, that's good. Now, I'm not suggesting you change how you calculate the Sharpe ratio. Certainly on an exam question, if you're given a 90-day T-bill rate, that's what you would use. And that would be typical. That's why I say normally use the 90-day T-bill rate. But I do think this question about what is your actual risk-free return, I think this is a really helpful way to consider whether somebody should be investing at all. Okay, if I'm carrying 20% interest on a credit card, does it make sense to go put money into a mutual fund that might make me 7 or 8% or even 10 or 15% this year, or might lose me 3 or 5 or 10% this year? And I would suggest, at least mathematically, it does not. Now, if you have behavioral reasons, fine, that might be enough to trump that high rate of interest. But I think you really have to have a strong reason to not service that credit card debt first and foremost. All right, that's good. Anybody think I'm nuts here? All right. Right, but still, is return not my change in net worth, Stephanie? Isn't that what my return really means? Or, put another way, this is really what you're adding, not having to pay that interest, right? So if I have a credit card, let's say a simple version here, I've got a credit card with a $20,000 balance, and I'll just use 20% here. I got 20% interest and divide by 12. So my monthly interest cost on that credit card is $333. That's right. That's coming out of my cash flow. Whereas if I have somebody who doesn't have that $333 of interest expense, okay, so I have somebody who doesn't have that $20,000 of debt, well, they can use that $333 to increase their net worth, right? Now, they may not. They may spend it somewhere else. We can't guarantee that they're not going to do that, but all else being equal, they have $333 that, yeah, nor would I. That's the point, Stephanie, right? I'm not adding the $20,000 into your net worth, but I am subtracting it from your net worth. I don't care about the balance here. That's not the point, although you can work with that. This does influence your net worth, right? So if that $333, no, that's not at all the point here, right? The point is that by carrying that credit card debt, I am losing that ability to use that $333 to increase my net worth. Okay. All right. Okay. Any questions there? Only the bank gets to put that $20,000 onto its net worth, right? All right, Jalen, you said you had more than one question. What else do you have? Sure we can. Yeah, let me just pop it over here. Yeah, I actually have this. I have a slide for this later on. Okay. I actually have this very thing in a slide later on. So yeah, we'll do that when we get to it in due course here. Okay, anything else? Yeah, we're getting into chapter 11 for sure. Yeah. Okay. Oh, so I have them in the titles, Ksenia. Sorry, Ksenia, I'm just going to show you here. So I do have them in the titles. Right? So where it's day 10. Okay, but Jalen, that's not fair. Nobody told me that that was uploaded incorrectly. I don't want to sound harsh here, but there's 17 of you or whatever. Somebody could have said that chapter is not right. And honestly, right at the top of the chapter, it says, like right at the top of the thing that I know is problematic, I get that, but it says this table is referenced in chapter 11. Like, I don't know what else I could have done there. It's mistakes happen. Everybody knows that you're in a trial here, right? So I certainly am trying to get everything perfect, but somebody just grabbed the wrong file and put it in there, and everybody can email me or post in the forums or whatever. So I don't feel like that's a fair comment, Jalen. Okay. All right. No, you'll be okay, Jalen. We'll go through it. You'll still have access to the material afterwards. There's no other choice. We can't push the course back a day and just take the day off, right? That's not going to work. So the only thing we can really do. Yeah, so New, the 2020 figures, actually, you'll see when you get to, well, what do you mean by going off of? I'm not sure, New, give me a context for that question. I'm not sure what your context is for that question. Okay, but again, are you asking about like when you're answering a multiple choice question? Because when you're answering the multiple choice questions, if you need an OAS or CPP amount, for example, it always gives it, right? Okay, so again, I need a context for that, New. If you have, yes, I mean, in real life, you should, it's 2020, you should be using the 2020 amounts, okay? In an exam question or whatever, you just use the amounts that are given. Okay. And certainly you'll see when you get into unit 13, for example, unit 13 was all written after. And part of the problem, New, is that those amounts are not available until, for the most part, December 1st. And a lot of the text was written before December 1st, right? So you can kind of see where edits were made or whatever before or after December 1st. So you'll see chapter 13, for example, it was done all after those amounts were available, and it does have the right figures in it. Okay. On your real life exam, yeah, we've talked about that. On the real life exam, it'll be the same as the questions. If you need a specific dollar amount, it'll be given to you. The style for the multiple choice questions from chapter to chapter is the same as the style with your actual exams with FP Canada. Okay, so nobody is memorizing the CPP amounts for 2020, for example. Is that fair? If you need the specific dollar amounts, you're looking them up. All right. Any other questions? And Jalen, I certainly don't want to shut down questions. I know you have lots of good questions, and I felt like that first question was a really strong question. It's a super perceptive question. Okay, so are there any other questions before we get into today's content? Your second question is obviously a good question too, because it's something we're going to cover today. Okay, I don't understand. I need that. What's the minimum amount, Melanie?
Sorry, Jason. I'm just asking what the minimum when we do personal taxes, that 13,000 or so, or the 12,000?
Okay, you're talking about the basic exemption. Yeah, I got you now. So,
right, sorry.
Yeah, I don't know that it's really, okay, what I would say here, I don't know if I would say tax-free truly, but what I would say is you earn that first, whatever it is, it's almost $13,000 now, tax-free, okay? And that really is a matter of perception, because that's assuming that you count from the first dollar up, right? So if I start from $0 of income and I get to that, whatever it is, 13, and now it's all complicated. There's 3 different basic personal exemptions now. But if I get between that $0 and $13,000, that first chunk of income is tax-free, right? I'm not paying tax on it.
Is it tax-free, or do we just do the 15% tax credit on it? I think that's where
Plus
I'm
your
confused.
provincial tax credit, right? So 15%. Federal plus your lowest provincial rate. So that's 10% in Alberta. Okay, just because you happen to be in Alberta, right? So that is tax-free income. Now, it is a matter of perception here, because if you're looking at it from top down, so if you have somebody who makes, we'll go $120,000 a year in Alberta, well, that person on that $120,000 of income, that person is paying tax at 26% federal and 10% provincial, right? So it's literally that the first $13,000 is tax-free, not the last $13,000 is tax-free, okay? And it is a matter, you have to be careful how you express that.
I think that's where I'm getting confused. Would I not, if it is tax-free, then I would just withdraw the first 13,000 from the initial tax calculation, would I not?
Sure, and you can do that. It's not, the problem is it's not accurate in terms of how the rest of your taxes are calculated. So it's still true that that first $13,000 is tax-free, okay? So this person is gonna have 3 tax brackets, right? They're gonna be up to about $47,000, whatever it is now. They're gonna be at that tax bracket, and then once they're at about $94,000, they're going to move into that next tax bracket. So here they're going to be at their 20.5% and 10%. Okay. I don't confuse that concept of that being tax-free with not including it in your income tax calculation, right? That's, I see what's going on. You've got those two things sort of crossed over, and that's not accurate. Now, you could do kind of what happens in the Chapter 9 assignment, the second Chapter 9 assignment for Pearl. It's just not how your taxes are calculated. But you could say for this person that you're only going to include whatever it is, $34,000 at the 25% tax bracket. And that's roughly correct. The problem is it's not precisely correct, because the reality is if you calculate it that way, you're going to get a wrong answer. First off, because Alberta doesn't actually have a $13,000 basic personal amount. That's where you have to do the credits individually. So yes, there is that first tax-free chunk of income. It's a tax credit that makes it tax-free. Okay. And you can say that about anything, right? So if this person were disabled, just for the sake of argument, as a person with a disability, well then I would have about $20,000 of tax-free income. But it's still all tax credits. It's not that you're taking $20,000 out of the tax calculation. You're still going to do the whole calculation, and then it's the tax credit that makes it tax-free.
I see where I kind of got confused there. They just basically cancel each other out, right?
It does. You still have to, though, do the full calculation and then apply the tax credits.
Right. Okay. Okay. I think I see where I got confused there.
Yeah, I get it. It's a confusing concept. I understand why that's the case. Okay.
Great. Thanks.
Thanks. Yeah. Okay. Any other questions? Oh, sorry. No memorizing YMPE and not the 5.1%. Those are things you would look up, Jaylyn, and especially remember this, that you're not memorizing any amounts that change year over year. You should know roughly where YMPE is. Sorry, Ksenia. They're both tax credits. Everything I just had on the screen there was a tax credit. Right? So the $13,000 is a tax credit. The disability tax credit is a tax credit. You just remember we did that before. You take all the tax credits, you add them up, and you multiply by the lowest tax rate. Okay. I didn't just change anything that we previously did. All right. Yeah, no, you're not supposed to have a bunch of stuff memorized, Jalen. I'm hoping that when you're writing the exams, you're seeing that, right? That you are given specific dollar amounts. If you need the OAS amount, it's in the question, right? If you need the CPP amount, it's in the question. Okay. Okay, that's good. All right, let's push on. And unless there are other questions, I'm happy to address those other questions. Okay, so like in class, Louis? Do you mean for the, like before you write your exams with FP Canada? Is that what you're talking about? If you sign up for exam prep, and we'll talk about that closer to exam day. We're only about halfway, we're just over halfway through the course now, right? But yeah, closer to exam day, you will have, we'll talk about all the different tools, not just BCC stuff, but all the stuff that's available out there in terms of practice exam and exam prep. Okay, and I'll make sure that you do have a good eye on all those tools. And then the exam questions themselves. So when you're working through the multiple choice in each chapter, those are written to be fairly close to what FP Canada shows you in terms of how you're tested. Okay, so that's part of my intent from day one here, is to get you used to the style of testing you're going to see with FP Canada. Okay. Yeah, I'm really loath to spend a lot of time on AMT, Melanie. It's a, I am frustrated with this, honestly. I'll show you what Melanie's looking at here. It's a super frustrating thing because to me, this is something that FP Canada got wrong in the body of knowledge, because there's something that you should know before you study AMT, and it's removed now from body of knowledge. So I can show you real quick here. Just bear with me for 1 second. There it is. Sorry, you're off mute still, Melanie. Okay, so we're going to go to AMT here. All right. So remember the key thing with AMT, we did this in class. Really all you need to know about AMT, the calculation is not something you're ever going to have to do. I said that in class. I said, this is not your job, okay? It's not going to be your job on the exam. It's not going to be your job in real life. That's good? So you don't get hung up on this too much. You're not worried about memorizing this or whatever the case. And the reality is, even this little example here, the simplest example I could possibly come up with for AMT, still is an endlessly complicated thing. What you really need to know here, and exactly what we did in class, is what's in this paragraph right here, which is that Cindy, based on having an AMT calculation, has an AMT credit now, and the financial planning element of that is now, as her financial planner, how do you help her to have tax payable so that she recovers that AMT. Okay, and that's exactly what we went through in Chapter 9. The only thing that I think people get confused on here is the use of the lifetime capital gains exemption. So everybody knows that we're at a 50% inclusion rate for capital gains normally, right? Does everybody agree with that? Okay, so in your normal tax calculation, what's really happening, I suppose I could put another table in here, that might be helpful. So in your normal tax calculation, it's this, and really what I've done here that I think I might fix with another table is you've got $900,000 of capital gains, and then you apply a 50% inclusion rate, and then you have a $450,000 taxable capital gain, right? Everybody who's done Chapter 9, the Pearl assignment, knows that. That's nothing fancy. That's exactly what we'd expect with a capital gain. Okay. In this case, though, unlike Pearl, Cindy has access to the lifetime capital gains exemption. Okay. So the lifetime capital gains exemption that I've used here is $850,000. Agreed? So that's an amount of capital gain on sale of certain capital property, shares of a small business. And this is what I find frustrating is we haven't talked about that sufficiently in the basic curriculum. So what FP Canada's done that I have talked to them about, and I hope they fix it, is they've said, well, AMT is in the basic curriculum, but sale of a business, which is by far the most likely thing to trigger an AMT calculation, is only in the advanced curriculum. So it's a little bit of a tough thing. Sale of shares of a small business and farming or fishing property. Okay, that's where you get to use this. And we take that times 50%, times that same 50% inclusion rate, and that gives me a $425,000 we call capital gains deduction. Okay, so I would take that $425,000 deduction and apply it against that taxable capital gain, which lands me at exactly what we see on the little table there, which is a $25,000 income amount. Ultimately, that's what's included in your income. That's what you're paying tax on. Okay, and that's what we see on the table here, right? It's exactly the same thing. It's just a slightly more complicated way of arriving at the same answer. But if you follow this through on the tax return, this is exactly what this looks like on the tax return, that I would show $450,000 of taxable capital gains at line 127. And then I would show at line 254 the capital gains deduction. And then ultimately at line 260, which is where we calculate our tax payable, that's where I would show that net $25,000. Okay, does that make sense? Okay. Then on the AMT calculation, yeah, that's right. So this is Cindy. Cindy's an individual, Ksenia, right? This is Cindy selling shares of a small business or farm or fishing property. Okay. Yeah, see, this is the problem, Ksenia, is that you're expected to sort of understand that without us having done that work. And that's sort of my trade-off here is how much time do I want to put into helping you to understand the lifetime capital gains exemption when it's not yet examinable, right? I think this is a mistake. I think that FP Canada hasn't properly considered this, and I do have a request pending for the body, for the entity, the committee that reviews the body of knowledge, to move that over into advanced curriculum. This makes no sense to me to have this in basic. Okay, so Stephanie, just don't look at that for a second. Okay. Do you agree with the first bit of math, the math that's actually in the box that we started with here? If it's an $850,000 exemption, do you agree with that? Okay, it's exactly the same thing. I have done exactly the same thing by just applying the inclusion rate after the fact here. Okay, so do you see that $900,000 of capital gains minus $850,000 of lifetime capital gains arrives at $50,000 of net capital gains? Do you agree with that? Okay, it's exactly the same as 900,000 times 50% minus 850,000 times 50%. That's still going to get me to $25,000, isn't it? Okay, that's all it is. It's the same exact outcome. I can show you this on the tax return, and I will in a second. I find that looking at this on the tax return often actually helps. And you may remember, Stephanie, what I said about that way back in chapter 7 was that when you're confused about a tax concept like this, and I don't know if you did this, Melanie, it was your question that triggered this, but when you're confused about a tax concept, pull out the tax return. Okay? That's going to answer the question a good chunk of the time. Okay, so now looking at the actual AMT calculation, the only differences here, there's two things that are different, is that on the AMT calculation, we're at an 80% inclusion rate for the capital gain instead of a 50% inclusion rate. Okay, and the other differences are, I guess there's three differences, that you get this little exemption, kind of like the basic personal amount for a person, but this is why most people don't pay AMT, because you get that exemption in there. And then no matter how much income you earn, all AMT is calculated at the lowest tax rate. There is no marginal tax rate or no graduated rate taxation for AMT. Okay, and that's it. And once we apply those three things, if we still have tax payable, that's when you have AMT to pay. Okay, I don't know if that helps or not, Melanie, but that's the sort of principle with AMT. Well, I don't know. I mean, tell me what's confusing here. Give me one number that does not make sense. So remember, okay, you can't, this is the problem. I need the numbers because you have to see how it works, okay? Remember, the base concept is that the Income Tax Act says, hey, good for you. You were able to use legitimate tax measures to reduce your tax bill to near zero. But we're concerned now that you're going to take all your great tax saved dollars and leave Canada and use that money to benefit some other economy. And to give a disincentive to do that, we're going to ding you with this AMT. And the basic idea here is if you stick around Canada, or at least you leave some money in Canada that continues to generate taxable income, then you're going to get that AMT back. But if you skip the country, which you're perfectly allowed to do, then you're never going to get your AMT back. That's all. So it's just that we want Cindy keeping that $900,000 that she just made. We want her keeping that in Canada and doing taxable things with it. Otherwise, what was the policy benefit of giving her that lifetime capital gains exemption? Okay, we give people all these tax advantages because we want them to engage in certain economic activity, but we don't want that economic activity to result in people taking their money outside of Canada. Okay, and just to, I think Stephanie's point largely, we'll pop over to the internet here and we'll have a look at the tax return. So this is what would happen with your capital gain. We look at line 127. So this person, if this is Cindy's only transaction this year, she would have a Schedule 3, and her Schedule 3 would show $900,000 of capital gains. Okay, but then on line 127, she would report 450. Does everybody agree with that? And therefore, total income would be 450. Okay, that's relatively straightforward, right? I don't think anybody would disagree with that. And then, keeping on going here, we would start off with line 150, and let's assume she has no deductions at all. There are no deductions from income. So there's still 450 here. There's still 450 here. Okay, the problem is she's still going to pay tax as of right this minute on $450,000 of net income. That's not the point, right? She has to find a tax benefit somewhere. So we got the 450 here. Well, here's where this tax benefit's going to show up. Remember what I said about deductions, that the deductions that we see down here between line 236 and line 260, these are deductions from net income. And these deductions are these sort of one-off events. They're not the spend money to make money deductions. These are the one-off deductions. Things that don't normally apply, things that most taxpayers won't have access to on a recurring basis. The one exception is, this is where the Northern Residence deduction sits. That is one that I know, for example, Kim would have access to and would have a bunch of clients who would have access to, Kim being in Fort St. John, okay, Northern BC. And then we look at our capital gains deduction right here. And that's where that amount has to show up, okay? Now, you see that if I put it on here as $850,000, well, is that a true story? Does that really show us what's happening with this capital gains deduction? So if I do it that way, I would get negative $400,000 here. Then I would have that would be not correct, right? So instead, when we show the capital gains deduction, we're going to apply, just like we saw a minute ago, we're going to apply the 50% inclusion rate. And that's going to land us then at $425,000. And once I take that $425,000, now I'll get the $25,000 of taxable income that Cindy ends up paying tax on. Okay, does that make sense? All right. Okay, perfect. Let's go to chapter 11 then, or we're sort of midway through the transition between chapter 10 and 11. There's a little blurring of the lines here. I guess technically we're still in chapter 10 here. And this is where we're going to look at the concept. Yeah, absolutely, Stephanie. Yeah. So, and in fact, this year, and just this is the frustrating thing I have about this lifetime capital gains exemption thing, Stephanie, because really we'll cover this in its full detail in advanced curriculum, right? But yeah, absolutely. If you only use $850,000 of lifetime capital gains exemption, this year the lifetime capital gains exemption is just under $880, if I remember right. So now you would have $30,000 of exemption available. Okay. So yeah, absolutely. You, as that amount increases, you still have the increases available, or if you only use part of it, you will have whatever you didn't use still available. Yeah, it's not a one and done thing. It's a dollar amount that you can use up to. Okay. So diversification. Now, first off, if I had somebody who could have bought Microsoft stock you can use Microsoft in 1981, okay, or we can use Apple in 2001, okay? Or you could have bought the market, sort of a broad-based balanced fund, something like that, whatever, a balanced fund, or even an equity index, I don't care. Which would you have done? So you've got a perfect time machine. You can do either of these things. Yeah, that would have been the right decision, right? Okay, so that's it. How rich do you want to be, Aaron? So yeah, exactly. Louis, if you had perfect 2020 foresight, this would have been the right thing to do. So you wouldn't diversify if you could make this purchase. Whereas you don't know, now if you did, good for you, but most people in 2001 did not foresee the iPhone, or you might remember the iPod was really the thing that was Apple's first big hit after 2001. So it was nearly impossible to foresee this. And it's the Warren Buffett quote here. And this is not negative, but Warren Buffett says diversification is a tool of the ignorant. Okay. And keep in mind, when he says that, he's a diversified investor. He doesn't have all of his eggs in one basket. He holds interest in a lot of different types of companies in a lot of different sectors. What he means here, when he says ignorant, he means it in the classical sense, is that we don't know. And this is why we diversify. You did not have that 2020 foresight that Louis wants us to have. So no way to predict, no way to know. That's where you diversify. Okay. Now, there are many different ways to diversify, and I would suggest that the two that people generally will think about here would be by asset class. Okay, so we diversify by asset class, and that means we're going to well, we could diversify by advisor, Angela, or by different institution. Yes, not good diversification. So by asset class, and this is where we hold some, and it depends what we look at here, but let's go cash, fixed income, and equity. Okay, and the idea here would be I hold some cash, maybe for buying opportunities, because there's no risk of loss of capital here. I hold fixed income because I know that it's got more stable pricing than equity, and it's typically negatively correlated to equity. That is, it's usually the case that if rates go up, okay, so interest rates go up, that means that my, while bond prices fall, it does mean though that I get better returns on fixed income instruments. Whereas when rates go up on the equity side, that's typically going to have sort of, at least in the short term, the other effect. So rates go up, it's harder for companies now to raise capital, and that's going to hurt equity. So normally we have that negative correlation with equity. And then equity, of course, is where we get returns in excess of inflation. But the problem here is that we have to accept a fair bit of volatility. So that's our sort of classic example of diversification. Bond, yeah, exactly, Jalen. Yeah, fixed income is bonds and debentures, yeah. Okay. Well, at least those are the two primary. All right, and then the other thing that we normally do as far as diversification is we don't just hold one equity, we hold a number of instruments in each asset class. Okay, and whether this is true or not, and there's some debate around this, this is kind of like our discussion around risk-free returns this morning, but whether or not this is true, at least one common mathematical model here, which comes out of the capital asset pricing model, and remember that was the thing that gave us beta and how we looked at different risk tools around things like standard deviation, says you want to hold 32 different investments not correlated to one another in order to be properly diversified. So the idea here would be that now cash, there's not 32 kinds of cash. So arguably a fully diversified portfolio would hold some cash and then would hold 32 different fixed income instruments, and then it would hold 32 different stocks. Is everybody with me there? Yeah, so for the average investor, Ksenia, it's going to not be practical to diversify to that extent, right? It's just not something that most people could manage. Just to come up with the amount of capital you would need to be that diversified is not realistic, right? Okay, that's good. But actually, I don't know if anybody pays attention to such things. If you look at your typical mutual fund prospectus, you'll find this is not an unusual sort of target for the portfolio manager. Lots of mutual funds hold around 30 to 35 securities. Okay. And that's normally what you'll see here. Yeah, and then you can go beyond that, Angela, right? We'll talk about fund of funds this afternoon. Yeah. Okay. That's good. Yeah, that's the reason, Stephanie. It's not a coincidence. Do you see that? The fund manager is using the same math that Markowitz did when he came up with the capital asset pricing model. It's not like the fund manager has just arbitrarily chosen that number of securities. Okay. Right, so 1 is perfectly positively correlated. Okay, -1 is negatively correlated. Okay. Okay. Any questions there? Now, there are other ways to diversify. Okay, there are other things that we can do to diversify. It's not just a matter of diversifying across asset classes and across our equity. What's the common criticism we hear for Canadian investors? Yeah, that's it, Ksenia. That exactly, Ksenia and Garrett are exactly on the same track here. This home bias leads to sector concentration. So we see this with Canadian investors tend to, now this is a little bit off today, but they tend to over concentrate on financials and resource stocks. Maybe some telecom here, but if we're looking at the Canadian economy as a whole, these two sectors, financials and resources, dominate. They will, depending on the time frame we're looking at, they might represent half the value in the market at any given time. And that's where Canadians do tend to over concentrate. So we should be considering diversification across sector. And there are, what is it, 14 sectors? I can't remember, but let's say 14 sectors. And you want to make sure your portfolio represents all of those sectors. And there are some sectors that are very difficult for a Canadian to find in Canada. Industrials are a great example of that. Industrial companies, really, there's no good example of a Canadian industrial company. Bombardier is probably the closest we have to something like that, and it fits in the transportation sector, not in the industrial sector. So yes, more bad news for Bombardier this morning, Angela, right? Okay. Yeah. All right, so we can diversify across sectors. We can diversify by geography. And again, that's something that Canadians tend to be not really strong at, although last 4 or 5 years, because of the problems in the oil and gas sector, we do, I think, see more propensity for Canadians to diversify by geography. How else can I diversify? So yeah, I can add other less conventional investments, Ksenia. So this depends on the asset classes we consider, but I might look at other asset classes. So I might look at, yeah, real estate. I know some people will put exit market offerings in here or limited marketing offerings in here. There's other ways that we can diversify. Some people would put insurance in there. I don't know if that really fits, but whichever. We can diversify by investment philosophy. That is, how do I invest? So talk about, yeah, that's true, Angela. I might look at active or passive. I might look at specific investment strategies like ESG. ESG, for those who are not aware, is so environmental, social, and governance, and that's where we have companies that have a something of an ethical component to how they operate their business. Okay. Yeah, that's true, Jackie. Yes, I can diversify within my own portfolio. So that might be diversified by investment objective or by time horizon. That's fair. I can diversify by product type. So maybe I have some mutual funds, some ETFs, some individual stock. Which ties in to some extent to specific investment philosophies. I can diversify by tax handling. And this is where I might have some money in RSP, some money in TFSA, some money in non-reg accounts. Okay. That's good. All right, so there are many different ways to diversify. There's some examples. My point here is we shouldn't just focus on asset class and then diversification of securities. We should be thinking about all the different ways we can diversify. Angela, I did not put diversify by investment advisor on there. Right. Okay. Okay, now we talked about this a little bit last time we're together, but when we look at this idea of correlation and then understanding risk, again, I just want to remind everybody, and this is not our first time seeing this, that we want to diversify by both volatility and value at risk. And sometimes these things are not well considered. So remember volatility. This is the primary measure of risk. for publicly traded securities. And what happens here, you make some investment and you're going to have something like this. Investments go up, investments go down, whatever direction. I want to consider that degree of volatility. Value at risk, on the other hand, remember, value at risk is how much can I lose basically in 1 second. And the issue here with value at risk, it's much harder to measure. The nice thing about measuring volatility is we have this easy mathematical tool. It's measured using standard deviation. Now, that's not necessarily 100% accurate. But it is what happens. That's really the tool that we have. That's it. Okay. Value at risk. This is a different concept. So as much as this thing is highly volatile with this stock, I can sell right here. Okay, if I'm panicky, I can sell my stock anytime. There are some investments, though, if we're looking at non-publicly traded securities, securities that have no public market, then it's much harder. And we can pick on Angela's comment about her Bombardier shares earlier when Angela said, oh, my net worth has taken a big hit here. Angela could sell her Bombardier shares today. That's perfectly fine. Now, it might not be the ideal thing to do. Whereas, let's say that I have shares, and I do, let's say that I have shares of Business Career College, which has no public market, and we get some bad news. We get news that, I don't know, whatever, one of our biggest clients is leaving, or that we've been shut down by the regulators, or something like that. Well, I can't sell my shares. There's not an opportunity to do that. They would just go from having some value to having no value overnight, or really in 1 second, and I can't do anything about it. Does that make sense? Okay. And there's nothing that the holder of those shares can do about that. It's really, you're out. So when you're looking at something that has no public market like this, the value at risk is significantly higher. You can look at something like real estate. What's the value at risk with a real estate investment? If I go buy a rental property for, let's say, $300,000. Yeah, now if I don't insure it properly, Jackie, that's quite true. I've just given my value at risk a lot higher amount, haven't I? So value at risk for a $300,000 rental property. Well, that's a fair point, Jackie, that it's $300,000 if not insured properly, right? Okay. If it's insured properly, then could I lose $300,000 all at one time? Unlikely, right? So this is where it's a low value at risk for a physical asset like this. Now, that being said, let's work through two slightly different scenarios here. Let's say that the rental property is in where are we going to go here? Let's say Guelph, Ontario. Okay, versus rental property in, where are we going to go here? I don't know what I'm doing for $300,000, but in Hinton, Alberta. Okay, and just for those whose geography maybe doesn't match up here, Hinton would be, this is a resource economy. And it's really about 100 kilometers from sort of the next major center. Is that fair, those of you that are closer to Hinton? That's, I think, useful characterization. Whereas in Guelph, here we have a fairly diversified economy. And it's fairly close. It's within about 30 kilometers or thereabouts of the next major center. So where's my value at risk greater here? Well, my $300,000 rental property in Hinton's not going to fall to zero overnight. If we get some bad news about that resource economy, it's going to hurt that thing quite a bit. Whereas there's no one bit of bad news, I would suggest, that's likely to wipe out the value of your property in Guelph. Is everybody with me there? Okay. So those two risks are not necessarily created equal. And I think we have to look at both volatility and value at risk in order to understand what's going on with the investments we're making. All right. We'll have a look at indexes and benchmarking here. And this is really a set of tools for determining how our investments are working out for us. Now, the primary benchmarking tool that we'll normally use is a set of market indices or market indexes. For a Canadian investor, as an example, we have this company, Standard & Poor's. Okay, S&P. And they run a whole bunch of indexes. They have thousands of indices, sorry. And those indices all track a section of the market. Okay, so what do I mean here? Well, this is where if the market, sorry, let's look at the Canadian index. So for example, we have the S&P TSX index. And what this does, it takes a weighted average of securities trading on the Toronto Stock Exchange and if those investments on the whole go up, the S&P TSX index goes up. Okay. Now, this is a little bit of complicated math. This is where we actually need a mathematician to show us how the indexing works. But essentially what happens here is you take, let's say, Royal Bank. Royal Bank is typically day in and day out the most valuable stock on the Toronto Stock Exchange. Okay, so Royal Bank, it's typically, it's the most valuable stock. It's going to have the most weight on the index. Okay, and we can compare that to oh, who do I want to use here? We'll use Bombardier since we talked about them this morning. So Bombardier is still a big company, but not as big as Royal Bank. And so what we would see here is if Royal and Bombardier both have their share price increased by 5% on the same day, the increase by Royal is going to have more impact on the index. Okay. Does that make sense? Yeah, it has more value. So the shares, the real, when we say it has more weight on the index, the reason we would say that is it has a larger market capitalization. And that's normally the primary tool it's used in this indexing math. So that market capitalization, that's the number of shares times the value of those shares. Okay. And so when somebody says Apple is $1 trillion company, Jaylin, right? That what they mean is if you take the number of shares times the value of the shares, that's more than $1 trillion. Okay. That's good. So that's it. It's just market capitalization. There are other ways we can value that. Not every index is based on market capitalization. There are different tools we can apply to get different types of indexes, but that's the most common one. The vast majority that you'll see use that. Now, what's the most common market index that we hear about? Especially if you're watching American news, that's it, Louis, right? So the most common you'll hear about is the Dow Jones. Like S&P, Dow Jones has a whole bunch of indices, but the one you're most accustomed to hearing about is the Dow Jones Industrial Average. And this is an old index. It's 140 years old now, something like that. And it holds 30 securities. That's all it's, that's not true actually. For about the last 60 years, it's held about 30 securities. That's all it holds is 30 securities. And the idea here is that it tries to be broadly representative of the US economy. And it's actually a big deal when a stock moves in or out of the Dow Jones Industrial Average, because that really shows that that company is no longer in such a dominant position, and there's somebody else who would be a better representation here. So Apple, for example, was clearly not around 130 years ago, but today Apple is in the Dow Jones Industrial Average, ditto for Microsoft, for example. So you have companies here that sort of represent the value, or you look at Alcoa, the American aluminum manufacturer. It was a big deal when they were pulled out of the Dow Jones Industrial Average, or Kodak when they left the Dow Jones Industrial Average. That sort of says, hey, that company is no longer a litmus test for the overall economy. Okay, so that's our indices, and there are tons and tons of these. So we talked about Standard & Poor's, we talked about Dow Jones. The other big one that you'll see with mutual fund companies is Morgan Stanley. Morgan Stanley also runs a whole bunch of indexes, and they're best known for their global indices. Okay, so those are the sort of three big ones you'll see. Normally in Canada, we use Standard & Poor's. That's the one that's most often represented. Now, there are other things that we can benchmark against. So we can benchmark against an index. There's the S&P 500, Jackie. The S&P 500 is actually a US index that's based on the US market. So the S&P TSX is the Canadian one that we should pay attention to. The S&P 500 is a US index, and it's actually often used as an alternative to the Dow. So not everybody likes the Dow. Some people prefer S&P 500. Yeah, so, well, that's mostly true. Anything that trades on the TSX would be most likely a Canadian company. Okay. There's some question around that. You could, like Encana, for example. So Encana still is a TSX traded company. I'm not sure how this is going to play out as it sort of moves its headquarters to Denver or doesn't move its headquarters to Denver. It depends whose propaganda, I believe. But yeah, that's it. The TSX is almost all Canadian companies. Really, there would be, for the most part, not much reason for a company that's not a Canadian company to choose to primarily list on the TSX. Okay. Okay, so I can benchmark against the index. And this is what we often look at with mutual funds is, let's say that my investment performance was, we went up by 8%. And the index was, let's say, up by 7.2%. Fine. However, you'll see this not necessarily always represented quite accurately. And as an example, what I want to look at here is this over the same time frame? Back to your comment earlier, Louis, is this net of fees? Did we take fees into account accurately on both? If my performance was 8%, but I then had to pay a 2% management expense ratio, well, that's not quite the same thing, right? Is it the same index? For example, was I using just Canadian equities in my portfolio and Canadian equities in the index? Or did I take more risk here? Okay, what if I used, let's say, emerging market equities? Now, should I be comparing that to a Canadian index? I should not. I should be comparing that to an emerging market index. So when I say I beat the market or I didn't beat the market, I should be comparing the market that I'm investing in to the market that I'm actually using. Okay. Does that make sense? Is everybody with me there? I've got to have a like-to-like comparison. Okay, so was it the same index? Now, what else can I benchmark against? There are other things that I can benchmark against other than just the index. Okay, that's a really good one, Aaron. I can benchmark against other funds. Now, similar to benchmarking against the index, I want to benchmark against other funds that have the same investment characteristics. And What's the big tool that we see used for that? There's one very widely used tool for benchmarking from fund to fund. Yeah, those Morningstar quartile performances, right? So when we see Morningstar, that gives us that 1-star, 2-star, 3-star, 4-star, 5-star rating, and that tells us how that fund has historically performed against its peers. You have to be careful with Morningstar because it is, of course, historical performance, and as much as that's the only information we have available, we also know that historical performance is no guarantee of future results. Okay, what else could I benchmark against? Sorry, Morningstar is all one word, but whatever. Okay. I could benchmark against my necessary return. If we did a financial plan and the plan showed that we need, let's say, 6%, okay, and we got 7%, hey, maybe now I've exceeded my benchmark, I can take less risk. Or save less, or have more ambitious goals, or whatever it is. I can benchmark against what I actually needed in my return. I have a tougher time with this one. It might be possible to benchmark against the FP Canada projection assumption guidelines. I'm not sure if I like that. I have to be really careful about how I benchmark this, but what I might look at here is maybe I compare the market to the guidelines, not necessarily compare my investments to the guidelines. And by doing that, I'm going to say, well, when we started off, we made these assumptions based on the projection assumption guidelines. Those assumptions are valid or they're not valid, and we have to readjust your plan, or we can keep your plan as it is. Anything else I can benchmark against? I can benchmark against the fund's historical performance, or the investment, I should say, not the fund, but the investment's historical performance. Okay, it's done this and this and this and this, and now it's doing this. And that benchmark might show me that maybe now I'm getting punished for excessive risk that the investment manager took to get good returns in prior years. It might be that our investment manager had a very, very long-term perspective and their investments didn't perform well over the short term, but over the long term, now they're starting to catch up. Whatever it is, I can look at historical performance for the fund as well. All right, any questions about indexes and benchmarking? Okay. Now, we've already touched on asset classes, and I said there are 3 different asset classes that we're normally going to use. Now, there are arguments for others to be included here, but at least for FP Canada purposes, we should generally use 3 asset classes. Okay, cash, fixed income, and equity. There are other possible asset classes. There's actually a whole bunch. We heard about real estate already. So some people like real estate as a separate asset class, and I have no reason to disagree with that. Some people like insurance as an asset class. Some people like exempt or alternatives as an asset class. Some people like derivatives as a separate asset class. We'll look at those later on this morning. Precious metals as an asset class. So we have a whole bunch of other possibilities here, but for our purposes, we're really just going to concern ourselves with the three. If you find yourself dealing with investors who hold a whole bunch of this other stuff, then yeah, you might have to tweak those asset classes. All right, so what are some examples of stuff that fits into each asset class? Well, cash, for example. So cash, relatively easy here. This is going to be actual physical cash, anything in a bank account. And I would suggest that generally we should also include redeemable or short-term GICs here. Really, anything that is or could be cash in the next 90 days. Oh, and I missed one on there. And that would be money market instruments. Sorry, I completely overlooked money market, our T-bills, and asset-backed commercial paper and the like. Okay, fixed income. As we heard already, bonds and debentures, mortgages as an investor, not as the mortgage holder. So this is where I would put most GICs, Stephanie. Most GICs would fit into the fixed income class, unless they are redeemable or very short term. Okay. In an exam question, if you have a GIC, normally there will be enough information about the GIC to help you make that distinction. Okay, and that's the idea here, is that there's not a hard and fast set of rules, but rather a set of principles that you apply to figure out where something fits. And then on the equity side, this is where we're going to look at common shares. That's going to be your most common equity investment. There are a couple of things that somewhat blur the lines here. What about preferred shares? Yeah, this is a question I'm not going to answer. That's kind of the point here, is that we have some blurred lines around preferred shares, where yes, on the balance sheet on the balance sheet they look like equity. Nice. All right. Yeah, on the balance sheet they look like equity, but as far as they behave in a portfolio, they can look more like fixed income, but then they take on some of the risk characteristics of equity, because if the company fails, of course, there's nothing for the bondholders. The other and there's actually a fairly high profile lawsuit about this, is what happens when we have debentures from smaller issuers. Okay, a debenture normally does behave like fixed income. But do you remember when we looked at bonds? I said, if you get into riskier bonds, remember we looked at bonds that fit into that junk category? And I said with those junk bonds or speculative grade bonds, that they start to behave more like equity. And this is where we've seen investment advisors actually get themselves into trouble, where they have loaded up a client's fixed income with these risky debentures, with debentures that were from smaller issuers and didn't have the same level of security as a bond normally would, and yet treated that like the fixed income portion of the portfolio. And then the portfolio blows up, and, or sorry, the issuer blows up and the portfolio gets wiped out. And now the client comes back and sues the investment advisor saying, hey, you built what you told me was a balanced portfolio, but it did not behave like a balanced portfolio. Okay, that's fair? Okay. Yeah, we're in a little, we'll talk about funds a little bit this afternoon, Angela. We're in a weird spot right now with funds. And I want to talk about that when we talk about benchmarking and funds this afternoon. Okay. But the fact is, a lot of income funds do hold at least some preferred shares, right? That's not unusual for income funds. That's kind of why you get that treatment. Here's what you really should be looking at. Instead of trying to memorize what fits where, what we should be asking ourselves is, why is it in the portfolio? And if we can identify why it's in the portfolio, then we can class it properly. Why am I holding cash in a portfolio? Why does an investor hold cash? Why not be fully invested? What's the benefit to sitting on any component of cash? Give some liquidity. Yeah, so you can take advantage of buying opportunities. We might have some uncertainty, right? You want to be out of the market. Those would all be reasons to hold cash. And typically those are your big reasons. You might be holding cash because you have a short-term need. There's a big ticket purchase coming up. Although likely you've moved that money out of your portfolio altogether at that point. Okay, why hold fixed income? What are the benefits to holding fixed income? Well, literally just that. It's providing income. That might be a reason to hold it. So your coupon payments here. That would be one potential reason to hold fixed income. Yeah, that's it, Aaron. It might be about capital preservation. Okay, little risk to your capital there, right? Might be about stability. Just having a chunkier portfolio you know is not going to be highly volatile. And normally what you're going to do here, you're going to see returns that roughly match inflation or maybe slightly exceed inflation. Okay, yeah, that's it. That's that stability. Louis, I would suggest that's really the same argument here. The thing to consider with cash, of course, is that your returns are nil or less than inflation. You're not going to match inflation with a cash holding. And then why am I holding equity? What's the benefit to holding equity? This is where I'm going to get returns, right? This is where I'm trying to get returns in excess of inflation. This is my long-term capital appreciation. That's it. I'm trying to build more purchasing power for future use, Angela, right? Okay. That's good. Okay, perfect. All right, this is where the question came up earlier. This was, I think this was, I can't remember now if this was Melanie's question or Jaylyn's question. I think this is you, Jaylyn, right? But this question about your statement of investment holdings. Now, just because it's where you asked the question, we'll pop to the next slide here. Oh, where did it go? There it is. Okay, sorry, I put that in the wrong place. Anyways, the statement of investment holdings. And this is maybe not exactly how you want to do this in something you show to a client. What I find is when we show this to a client, it's almost always done as a set of pie charts. But this is really the input that goes into those pie charts. What'll happen here is maybe you'll have a piece of software that does this, or maybe you do it yourself manually, but you'll take all the client's holdings and lay them out. And I would suggest this is at least one way we could lay this out. It's not necessarily the only way, but one way we could lay this out in order to arrive at an understanding of what the client holds. So the way that I've done this, I broke it down into two sort of sets of categories where I have cash, income, equity, and real estate. So I did a 4 asset class model here. And then for the second, where is it geographically located? And I did that because that's representative of the type of asset allocation that I think is probably important for Don and Cynthia. I think this is probably good enough for them to be able to be properly diversified. Now, what I could have done on top of this is I could have done a sector breakdown. I see a lot of people that would also do a sector breakdown. Most software today will give you a sector breakdown. I don't know if the average investor knows what to do with a sector breakdown. That's where I wasn't too fussy about it, but I could have said how much do they have in resources, how much do they have in healthcare, how much do they have in consumer staples, and so forth. Okay, so I could have gone a step further than this. I didn't see that it was particularly useful in this case. And then for every asset, I just pegged it accordingly. So Don's balanced fund here is, I think, a good example. So Don, in his defined contribution pension, holds a balanced fund. That balanced fund has a value of $40,400. And based on some information we get from the fund itself, we see this breakdown. This is where you'd need some supplemental information. But based on that breakdown, I'm able to determine that 40% of that value is income and 60% is equity. That's all. I just put the dollar amounts in there. It's all Canadian. So I've been able to pin that all down, okay? And then I would do the same thing for the global balanced fund. The global balanced fund is pretty much the same, except that it's all foreign then, okay? Yeah, so for a defined contribution pension, Don might have a statement here, and really what it almost certainly is that this Canadian Balanced Fund is a mutual fund or maybe an exchange traded fund that Don has the choice to invest in. And I might get the information directly from the pension, or it might be that I have to go and research what the actual holding is. Okay, so as far as figuring out what that looks like, that's where I might have to look at the fund facts for the underlying fund. And the pension will tell me what the underlying fund is. Okay, that's all good. And fund fact statements are available. Yeah, they are. They have to be, in fact. They have to be available to the public. So whatever the investment dealer is, their website will have all their fund fact statements on them. They're not always that easy to find. Sometimes you have to have a little bit of Google foo to be able to track them down, but they are all there. Okay, and it's probably just easier for you to look it up yourself than it is to ask the client. The client will almost never have anything terribly useful outside of that sort of first level pension statement that they bring you that shows the values and the percentage breakdowns. After that, you're probably better off pulling that from. Yeah, so I'll show you, Jalen. We'll go over to a website in a second and have a look at that. Okay, any questions here? So I built this in Excel, and then it just totals out on the bottom. So you arrive at your totals. And with those totals, then I can start to see where there's opportunities or problems. And I broke it down by total assets and invested assets. It's really the invested assets I care more about. They have a lot of real estate holdings just from their house, and that's where that's going to skew everything else. So I just want to look at the invested assets, and I can see a few different things here. So cash is 6.3% of their portfolio, fixed income is 27%, and equity is 66%. That's a useful thing to know. That tells me what their asset allocation looks like. I can compare that to the model asset allocation that I got based on their Know Your Client information and figure out whether any sort of rebalancing is necessary. And I should be checking that periodically, especially a case like this where you have a client who has some money in a pension and some money invested with you personally. This kind of thing gets a little bit sticky as far as actually tracking asset allocation. And this is a place where the financial planner will often be kind of at least the first resource for making sure that we stay roughly in a good asset allocation model. I do see over on the right-hand side here a little bit of a problem. And very typical here. Why doesn't my RESP contribute to net worth? It is theirs, though. It absolutely is theirs. Yeah, you sure do own it. And if you don't believe me, get separated with an RESP as an asset. Okay. That's good. An RESP is absolutely your asset. And yeah, the kids are going to use it for education. I hope, right? Sure. Well, now we'll talk about the RESP in tons of detail in chapter 14. Okay. Yeah, and especially if you have maybe is this a separation where there's stepkids in the mix, Logan? That's the one where I see this come up. Oh, there's and then there's a fight still. Interesting. Because I often see that's not such a big deal. Yeah. Interesting. Yeah, see it with stepkids. Or before you go to school, Ksenia, that's what I was going to mention here, is if you have somebody who has an RESP, a well-funded RESP, and they run into financial difficulties, you can take the principal out of your RESP before the kids are in school. Okay. Yeah, we talked about that back in chapter 3, Jackie. What I would use as the return here, I would use historical information. So in their case, it should be pretty easy to find out. All I would do here is, now there's different things I could look at here. I could look at what did you pay for it when you bought it? And then what's it worth today? That to me is the easiest thing to do. Yeah, that's right, Jackie. And that's a simple time value of money then. Now, what I could do on top of that, that's it, Louis, right? Maybe you include renos and maintenance costs as cash outflows. And if you're going to do that, the problem is that, yeah, that's right, Ksenia. Yeah, that's normally true. Yeah. What I could do here, if I'm going to do that, then I need to use Excel and solve for IRR. Okay. Unless I had exactly the same reno budget every year, right? Which is probably not realistic. But if I had those periodic cash inputs, you know, redo the roof, repave the driveway, whatever, that kind of stuff is going to be lumpy, right? And that's where you need to do an internal rate of return calculation. And you really need to use Excel to do that internal rate of return calculation. Okay, that's good. All right, let's just pop over to the Sun Life Global Investments website quickly here. We'll look at fun facts, and then we'll take our coffee break. Okay, so I want, and SLGI is Sun Life's investment arm. Okay, and whatever we have here, so I've got, I don't want the India Balanced Fund, I want a, there we go, we'll use the BlackRock Canadian Balanced Fund and do A series. It's not going to make a big difference. The A series and the F series are going to be the same investment mix. That's not going to be any different. It's just the MERs that'll be different. So right here, I can see what we've got going on. A little pie chart, like I said, that shows me how this is broken down. So Canadian equities, Canadian fixed income, foreign equities, foreign fixed income, and cash equivalents. That's good. And that's fairly typical. This is what you should generally expect to see when you see a fun facts document. Yeah, it's true, Ksenia, that fun facts only has to be updated semi-annually. So they typically are a little bit outdated, but unless something really wacky has happened. Yeah, I'm only looking at this, remember, for the asset mix, and the asset mix is probably still very much the same. And of course, so you have access to a paid Morningstar account, right? Not everybody on the call has access to a paid Morningstar account. But yeah, if you do have a Morningstar account, then you'll get a better breakdown there. Okay. That's good. All right. Yeah, I like Morningstar. It's a great website, but I'm not paying for a Morningstar account. All right. I don't even know if I can actually. Okay. That's all good. All right, let's take a break there. I have 1 minute past the hour. Take a 15-minute break. And we'll resume then at, I guess now 17 minutes past. We'll see you back then. Thanks, everybody.